Hello and welcome. In this video, we are going to discuss on how to ace through round 1 of Capstone 2.0, and we're going to start with the R&D department, marketing, production, finance, and then reports. So before you can make any decisions, we are going to check on our reports, which is here, and then you can click on the first report. That one brings the report for the previous year. So in our case, this is the report. It gives us the picture of how the previous year was. So in this case, you realize that we have several companies. That's company Andrews, Baldwin, Chester, Digby, Airy, Ferris, and in this case we are company Andrews. And given it's round 1 of our competition rounds, we are all starting from the same position. You can see and compare it with our competitors, and then so we'll go back to our decision making pages. So we'll start with the R&D. So looking at the R&D, we have product able, Acre, Adam, Aft, Agape, and going back to our reports, we realize that we have various segments. So for instance, we have traditional market segment, we have the low end. This is the traditional. We have the low end segment analysis, we have the high end, we have the performance, and we finally have the size. So we have 5 market segments, and these 5 market segments have different customer buying criteria. So for example, this is the high end. We realize in high end, customers are considering products that are well positioned, followed by age, MTBF, and then price. Looking at the low end, price comes first, followed by age, positioning, and MTBF. In traditional, here customers prefer a product with an age of 2 years, followed by price, positioning, and MTBF. So this traditional customer buying criteria are going to help us in making decisions for our product able, and those ones for the low end will also help us in making decisions for our product Acre. So we'll go back to research and development, and looking at it, you realize that it's in the low end, and in research and development, you're going to make decisions in performance, size, and then the MTBF. So in this case, we had settled for a performance of 8.8 and a size of a performance of 6.1 and a size of 13.1. And a size of 13.9. Then we settled for an MTBF of 19,000. Our next product was Acre. Looking at Acre, it's in the low end market segment, and in the low end market segment, looking at the customer preferences, they prefer a product which has an age of 7 years. And looking at our age profile, if you're going to make any decisions in ideal positioning, that's performance and size, you're going to cut the age into half. So to avoid that, we are not going to make any decisions for Acre in the R&D department. You're going to leave it as it is so that it can mature to an age of 7 years. So we'll go to our third product, which is Adam, and it's in the high-end market segment. And looking at the high-end market segment, customers' preferences, ideal positioning is the first one with a percentage of 43, followed by age of 0 years, meaning customers here are preferring products that are new, and an MTBF of 25,000 hours. So in this case, we're going to give it a performance of we're going to give it a performance of 8.8, and then we're going to give it a size of 11.2. And then we'll give it an MTBF of 25,000. Given it's a high-end product and customers want products that are high performing, so we're going to give it an MTBF of 25,000, which is actually the maximum. And then we'll go to the next product, which is aft, and it's in the performance market segment. And looking at performance market segment, reliability has the most importance, 43%, followed by ideal positioning with a performance of 10.4 and a size 15.3, and it has 29% importance. So in this case, we are going to settle for an MTBF of 27,000. And then given it was the first thing to be considered, then we look at the ideal positioning. They needed a performance of 10.4, and we actually settled for that 10.4 and a size of 14.7. We increased our performance by 1, so that's 10.4. And then our final product is Agape, which is in the size market segment. And looking at our customer preferences, ideal positioning has the most importance, that's 43%, and they need a performance of 4.7 and a size of 9.6. So in that case, we settled for a performance of 4.7 and a size of 9.9. Size of 9.9, and then we gave it an MTBF of 20,000, which is the maximum. Not really, the maximum is 21,000, but we're going to give it 20,000. And then, given that we have 5 products, we're going to introduce one new product, and we are going to place it in the size market segment, and this is going to help us maximize on the market share for our company with competition, with reference to our competitors. So in that case, we're going to introduce a new product in the size market segment, and here we are going to give it a performance of 5.6. So before you can make any decisions for it, you're going to give it a name, and it should start with A, given that our company starts with the letter A. So we are going to name it Arctic, and after naming it Arctic, we're going to give it a performance of 5.6. And then you're going to give it a size of 8.9. And this because we want it to come out in next year, so that's why we are giving it slightly higher than whatever we gave for product Agape, which was initially the size product. And then we'll give it an MTBF of 21,000. we are done with it. So this is the prices we are going to use in manufacturing our products. So from there we'll go to the next department, which is marketing. And in marketing we are all going to make decisions in 3 categories. That's the price, promo budget, sales budget, and lastly the forecasts. So in this case, based on our customer buying criteria in traditional, price has the second most importance, which is 23%. So in this case we settled for 28.25, and then we're going to give it a promo budget of 2000 so that we can increase our awareness. We're also going to increase our sales budget to 2000, and then we had forecasted to sell a total number of 1480 units. And then we're going to the next product, which is Eka. In Eka, it's in the low end market segment, and pricing has the most importance, with a dollar range of 14.50 to 24.5. So in that case we are going to settle for 22.50. Then we are also going to increase our promo budget to 2000, and our sales budget to 2000, and then we've forecasted to sell 2200 units. Go to the third product, which is Adam. In Adam, it's in the high end market segment, and here price has the least importance with a 9% importance. So here customers don't really care about price so long as the product is high end and sleek. So in this case we are going to settle for a price of 39.25. Going to raise our promo budget to 2000 and our sales budget to 2000 also. That's to increase accessibility of our products. And then we had forecasted to sell 650 units for our product Adam. Product Aft, which is in the performance market segment, here price has the third most importance with 19%. So we settled for a price of 34.25, and then increase the promo budget to 2000, sales budget to 2000, and we had forecasted to sell 610 units for product Aft. Our final product is Agape, and based on size market segment, price has the least importance, and we settled for 34.25. Price the promo budget to 2000, sales budget to 2000, and we had forecasted to sell 550 units. So that's our final product in marketing. And then after marketing, we are going to look at production. And in production, we're going to make decisions for the production schedule, and then we are going to make decisions for capacity and finally automation. So our first product is able, and we had forecasted to sell 1,470 units. So if you have an inventory of 189, we are supposed to factor in the inventory. That means you're going to take 1470. We subtract 189, and in that case we have 1,280 units. And then looking at our capacity, we are going to sell a capacity of 50. We're going to sell a capacity of we're going to buy a capacity of 50 to make it 1850, and then we're going to buy an automation of 0.8, so we'll do it 4.8. We'll increase the automation to 4.8. Automation helps in reducing the labor costs, therefore maximizing on profits. And given we were pricing our products slightly cheaper, so you're going to have an advantage when we increase on automation. The next product was acre, and on acre we have unit sale forecast of 2,220. So we subtract an inventory of 39, and we are remaining with 2,108 units. So we're going to produce 2,180. And then we are going to buy an automation, so we'll give it 6.3. We'll increase the automation to 6.3. And then for capacity, we are going to buy a capacity, and we are going to increase it up to 1850. And then our next product is Adam in the high-end market segment. We had forecasted to sell 680, and we have an inventory of 40. So if we factor it in, we are remaining with 640 units. And then we are not going to buy any capacity, and we are going to increase our automation to 3.3. Our next product is Aft in the performance market segment, and here we have an inventory of 78, and we have a unit sale forecast of 610. So if you're going to subtract it, you're going to get 532 units. And then we'll go to the next product, which is our final product, and it's Agape. So in Agape, we are not going to buy any capacity, and we are going to increase our automation to 3.5. And then for our capacity, we are not going to buy any capacity. We will retain our 600. And then there is the final product, which is our new product. We are going to buy it a capacity of 200, so that by the time it's coming in the market next year, the year 2027, we are going to have a capacity of 200. And then we are going to buy it an automation of 3. So with that, we are going to When you look at our maximum investment, we have a maximum investment of $32,693, and we are at 34,220, and it's blacked out in red, meaning we have gone out of our budget. So we are going to reduce on some of our products, either capacity or the automation, so that you can meet the expectations of our funders. So in this case, looking at Arctic, which is our new product, will retain an automation of 3 and a capacity of 200. And looking at Agape, we have an automation of 3.5, and looking at Aft, we have an automation of 3.5. And then looking at Adam, for our product Adam, we are not buying any capacity, and we bought an automation of 3.3. And looking at product Acre, in product Acre we increase our capacity to 6.3, so you can reduce it to 6. And so we are still blacked out. And then looking at Able, product Able, will reduce the capacity to 4.7, and now we have spent 32,460 out of 32,693. So we are good to go. We'll go to our final department, which is finance. And looking at finance, so here we can either raise capital or spend capital. So because this is our first round, we are investing in our company, so we are going to borrow. This is the current debt, then there is the long-term debt, there is the issue stock. So we are going to borrow a maximum of 10,000, and then we are going to take a long-term debt of 12,000. And then we are going to take an issue stock of 5,000. So our closing cash position as of December 31, 2026 is $16,920, and that's good to fund our decisions in the next round. So from there we look at our reports and look at our pro forma and see how we are performing so far. So looking at our reports, we have a leverage of 8 out of 8, a stock price of 8 out of 8, profit of 2.8 out of 9, and we have a total of 18.8 out of 25. And we are missing points on profit because we used most of our money to invest in company developments, so that by the time we are in our final rounds, we'll be stable enough, and we'll raise a lot of money and make a lot of sales. So for example, we introduced a new product which is quite expensive. We're just investing, and we're making a strong foundation, and we're going to score great in the coming rounds. So our round total is 52.7 out of 82, but we'll hopefully improve on that in our next round.